What does it mean to exit a business venture? Well, exiting a business venture simply means where a shareholder, an owner of the business, sells their interest either to a third party or back to the company and leaves the business, is no longer affiliated with the business. You'll oftentimes hear the word exit referred to in terms of an exit plan. That is, when an individual founds a company and seeks to ultimately sell or get out of the company, or an investor invests in the company, ultimately they have a plan to cash out and get out of the company. The exit plan is the means or method by which they're going to do so. That is oftentimes by selling the company, going public, combining, or simply shutting down the venture after a certain amount of time, which is more common in small businesses than it is in startup ventures. But with that being said, there's also a relevant concept called early exit. So an early exit is simply a scenario where an individual leaves the business earlier than expected. That is, a founder becomes disgruntled for whatever reason. That could be personal reasons, company operations or change of culture, financial issues in the company, personal bankruptcy, or lack of funds or liquidity, or anything that's going on in the personal or professional life of the individual. They simply step away. Investors frequently do that when they need to liquidate capital to invest in something else. So they may sell their interest either back to the company or to a third party earlier than expected to create that liquid capital to take another investment opportunity. The big thing about an early exit is that it needs to be planned for in any way as a contingency. That means basically preparing for the scenario. Oftentimes, business ventures will enter into employment agreements with founders to make certain they don't simply step away from the business at any point in time. That is, they are locked in contractually and have financial and other legal incentives to stay in the business and continue working in the business. With investors generally seek this as a protection means or method. Other methods of protecting against early exit is to make any equity that is sold to investors non-transferable or restricted for a given period of time. This may be a legal requirement pursuant to the securities regulations, particularly Rule 144, that's used in conjunction with many exemptions from securities registration, or it simply may be that the sales are sold under a restricted status by contract to keep from otherwise flooding the market with the shares or somehow otherwise disturbing the financial situation of the business. So this is what it means to exit entrepreneurial venture, and this is how the term early exit is used.